So the move toward that 3,000 is simply a technical piece where, again, you suppress the price and now the price is running because it's broken above that top. That's still 3,000 will still not reflect its true fundamental value. And I did just a little quick calculation on a global basis. So here, I'll throw this out at you, Kai. If you think 3,000 sounded insane, how about 40,000? Because somebody asked me, well, what would it take to set gold behind the currencies like we're seeing what's happening in Zimbabwe? Maybe that's the beginning of a movement to utilize gold to regain the public confidence in the currency.
Gold prices have soared past $2,400, reaching a new record high on Friday and marking the precious metal's fifth consecutive week of gains. This surge is fueled by increasing market demand for safe haven assets amid escalating geopolitical tensions and uncertain global economic conditions. The recent sharp increase in geopolitical tensions, particularly in the Middle East, has overshadowed optimistic remarks from Federal Reserve officials. Given the persistent strength of inflation and the robust state of the U.S. economy, the Fed's inclination towards gradual interest rate cuts throughout the year contrasts with the prevailing uncertainty in global markets. From a technician's perspective, Lynette Zang highlights that the recent gold price breakout was inevitable. Despite efforts to suppress it, the underlying economic realities eventually lead to a breakout. This breakout is significant because it reflects the true fundamental value of gold, which may be much higher than its current price. Regarding the fundamental value of gold, Lynette contends that the current price still does not reflect its true worth, suggesting that, on a global scale, gold could be valued at $40,000 per ounce to cover existing debt. While such a scenario may not unfold immediately, it highlights the severe undervaluation of gold relative to global economic conditions. Similarly, the monthly chart for silver reveals a large bull flag pattern, suggesting a potential for sharp price rises if the breakout from the flag is sustained. Like gold, silver has formed technical patterns indicating its undervaluation. Recent developments suggest that silver may be on its way to breaking out from these patterns, potentially leading to a significant increase in its price. Silver touched a high of over $29.50 an ounce on Friday, but the market has since taken a more cautious stance. Silver's price action took the lead from gold prices, which were more stable on Tuesday as the markets took a breather after recent all-time highs. We will present clips from Lynette Zang's interview with Soar financially. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
There is so much to unpack in that question, but I'm going to take it from the simplest place, the most obvious place first, because when you're talking about gold, technically, remember, it had like basically four tops, right? So that means that the spot price of gold would go up to this level and then pull back. And it did that four times, which is very, very, very unusual. And it's really more acts like a spring, right? So if you put pressure, wait, I have a spring. Let's see. So if you put pressure on something and you hold it down because a rising gold price is an indication of a failing currency. Central banks and governments do not want people to understand that that's what's happening. But the longer you hold it back, the higher that spring will go when it is released. When it is released. So what's happened from a technician's perspective is exactly what I just showed you. The price of gold had been suppressed, even as global central bankers have been buying it as quickly as possible at the highest levels as possible, because they certainly know what they're doing to their currency. So technically, this breakout had to occur. I mean, personally, I've been in these markets I became a stockbroker in 1986. So a four peak top is so unusual. So the move toward that 3,000 is simply a technical piece where, again, you suppress the price and now the price is running because it's broken above that top. That's still 3,000 will still not reflect its true fundamental value. And I did just a little quick calculation on a global basis. If you think 3,000 sounded insane, how about 40,000? Because somebody asked me, well, what would it take to set gold behind the currencies like we're seeing what's happening in Zimbabwe? Maybe that's the beginning of a movement to utilize gold to regain the public confidence in the currency, right? Well, in order to cover all of the debt that's out there on a global basis on a 1-to-1 ratio, which is probably not going to happen immediately. I would be surprised if it did. We're not ready for that yet. But in order to be at gold's fundamental value in relation to dollars and relation to the debt on a global basis, you would see spot at $40,000 an ounce. That's way, way, way higher than the 3,000. But that is a reality. It is severely undervalued because it benefits the governments. With silver had been forming, I don't know how to do this in a way to show people, but in a wedge, like a wedge of cheese formation with a series of higher and higher lows and lower highs. And when you get that technical formation, if it breaks above that wedge, if you kind of think about what it looks like for a wedge of cheese, when it breaks above that wedge, then it's going to jump up just like you saw gold do. So silver, whereas gold has finished some technical formations, that cup formation, and it did break out, and then it was suppressed for, to your point, a couple of years. They kept pushing it back. Now that has been released. And with silver, this could be, I'm not prepared to put my technical neck on the line yet on this, but this could be on their way to concluding that cup, because in both cases, gold and silver are severely undervalued to their fundamental value.
Top U.S. central bank officials, including Federal Reserve Chair Jerome Powell, recently refrained from offering clear guidance on potential interest rate cuts, indicating a prolonged need for restrictive monetary policy. This stance dashed hopes of significantly reducing borrowing costs for investors this year. Despite policymakers' earlier statements linking rate cuts to increased confidence in inflation reaching the Fed's 2% target, recent data suggests that price pressures may be moving in the opposite direction. Contrary to claims of monetary tightening, Lynette challenges this narrative by highlighting the persistent looseness of financial conditions. She argues that a closer examination reveals a reality at odds with the notion of significant tightening measures. Central to policymakers' assessment of economic strength is the ability to sustain borrowing levels, a reliance not limited to the United States, but extending globally, notably in countries like China. Lynette draws attention to the behavior of the Treasury bond market, which forms the cornerstone of the global financial system. However, concerns have arisen since 2015 regarding the market's stability, which has been marked by illiquidity and flash crashes. These fluctuations resemble a shaky foundation, raising doubts about its reliability amid rising interest rates and fluctuating demand. Let's get back to the interview.
First of all, you got to understand that the job of Jerome Powell, just like Janet Yellen, just like anybody that has a face that is in some level of political office, their job is to keep you in the system and to keep you calm. So if their lips are moving, they're lying. Okay, you need to really be clear on that. Their job is not to support you. It's to support the system that they created that keeps them in power. So I seriously question the real strength of the economy, because what they're really saying here is, Jerome Powell says, well, look at this. We raised rates. We're tightening. But if you go into the Federal Reserve Economic Department, the Fred, F-R-E-D, everybody can access that, and you go into, just in the search bar, financial conditions, you are going to see that the real tightening is just jawboning, but conditions, financial conditions have been as loose as they've ever been almost. So, that discovers the lie to begin with their own data. So how strong is the economy? Well, what makes an economy strong, according to central bankers and governments, is the ability to borrow more money. So you have the consumers that they're depending upon, and this is not just true in the US. This is really they're counting on it on a global basis. Look at China. They're looking for the consumer to support all of these debt yields and all of this. Is that the treasury bond, which is the foundation of the global financial system and has proven illiquid since 2015 was the first flash crash in it, and we've had several more since then. It's like the foundation of a house. If you've got a house and this foundation is moving like this, which is what's happening with the interest rates and with the demand in the treasury bond market, are you going to stay in that house while the foundation's going like this? Or are you going to flip and get out? So when they talk about the interest rates, a lot of it is jawboning. And the theory is, why in the world would you want to hold gold when you can get interest from a debt instrument? Well, my question to you is, why would you risk 100% of your principal for a measly 5% interest that is constantly losing value because of inflation that they created? And didn't they, but oops, and not working.
We've seen it in action before, Lynette.
Sorry about that. Well, just like the central bank, if it doesn't work here, they'll figure out another way to do it. So I think it's really important when we're looking at interest rates that if you go back to any of the Federal Reserve maps, I mean, the Fred is probably one of my favorite sites because I think it's a little bit more honest, because who goes there? But you'll see these gray bars, and the gray bars indicate recessions, official recessions, which they get to declare. And what you're going to see is their attempt to raise rates. This was a 40-year pattern, right? Every time we'd run into a recession, boom, they would drop those rates, 5.5% to 5.75%. And then down the road, thank you, they would attempt to raise those rates, right? And every time they raise those rates, that would push us into another recession, because corporations and individuals are dying. They're smothered in the level of debt that you either have to service, you got to roll over, you got to pay off, or you're going to default.
Last week's gold surge, hitting $2,417.92 amid geopolitical tensions and robust U.S. data, showcases its resilience. Breaking free from suppression, gold's movement resembles a spring under pressure. Despite attempts to restrain it, the prolonged suppression fuels upward momentum. Despite its surge, Lynette suggests that undervalued gold could hit $40,000 per ounce. While ambitious, this reflects uncertainty in global markets and offers cautious optimism for stability-seeking investors. Share your thoughts on Lynette's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.